Hi guys, so today we are filming our latest podcast with the Spry guys and obviously with Alex Funk, the Chief Investment Officer at PortfolioMetrix UK. Really tough to have you on board here, Alex. I know it's a little bit different in terms of the setup and a little bit different for us in terms of how we normally like to do our podcasts and all those things, but I'm really excited at the opportunity to get to chat with you and pick your brain a little bit and hopefully provide a bit of clarity and a bit of insight for our clients with all the goings on. And
Super.
Maybe I can intro you to all of our clients just quickly. So Alex Funk is the Chief Investment Officer of PortfolioMetrix UK. Been in the industry for quite a long time now, north of a decade from what I understand. Joined the PortfolioMetrix team, been doing amazing things. I saw you guys recently won an award, which is amazing. So just cleaning up from that point of view. But I've really enjoyed the kind of process that we've had with PortfolioMetrix, understanding how you guys manage client portfolios and the value you add to our clients through obviously the portfolio construction and just the day-to-day management of those funds. So I'm really excited to chat with you today and obviously go from there.
Yeah, super. Thanks for having me on, Travis, and nice to meet everyone as well. Joining you from a very sunny Victoria in London today. So looking forward to the chat.
Yeah. So Alex, obviously a lot going on at the moment, a lot. So you've got your political kind of tensions, you've got your shouting matches in the White House and the Oval Office situation. We've got Zelensky and Trump having a bit of a go at each other. You've got budget being pushed back in South Africa, and you've got obviously the trade tensions or the trade tariff situations, reciprocal tariffs coming into play. All of these headlines that have been dominating investors' minds, investors' thoughts. So I kind of wanted just to chat through how PortfolioMetrix views those, how you not necessarily react, but prepare for those kind of situations, and maybe a few strategies that you guys implement in order to kind of mitigate those kind of the impacts, should I say, of those situations. So maybe if I can lead you a little bit with my first kind of question, my first point is maybe PMX's viewpoint around strategies in terms of diversification of assets and all of those sorts of things in terms of the portfolio construction.
Yeah, no, it's super topical. And as you mentioned, there's lots going on. I sort of started the point that there's always something going on. Right. Yeah. And so we're often alluded to the fact that this time it's bigger, it's more impactful until the next time. Right. And so that's our frame of reference. But what you allude to is diversification. Right. So diversification, I think, is often used quite loosely by investors. And I think the most literal interpretation of what we're talking about is investors don't want all of their wealth generated or protected from the same source, right? You ultimately want many horses in the race, and you want them to win different races at different points in time, right? The challenge in today's market, though, right, Travis, just as you mentioned, is the perception between perceived diversification and actual diversification, point A, and point B is what are the things you actually can diversify away? You know, the trap I think many investors often fall into, and I mean, this is asset managers, investors, some of your clients, is confusing the number of positions with increased diversification, right? But this doesn't often help your diversification benefits if they all are aligned on the same market outcome, right? Yeah. So quite a simple explanation, having 100 stocks in your equity portfolio doesn't help if they're all linked to the ongoing consumption of the US, right? So making sure that you have different sources of return, different sources of risk, because remember, we must consume risk within the market, is quite important. So that's my starting point on diversification. The second thing is like, what is it that you actually want to diversify away? Remember, we must consume some risk, right? Is the price we pay to get an investment return. So what are the risks we have to consume? The growth rate of the economy, the level of interest rates, what inflation is, the change in inflation, geopolitical risks, corruption. All of these things are the risks you must consume for being an investor in the market. Otherwise, if you don't want to consume that, cash is where you have to be. But we know what inflation does to cash, so that's not a really good investment strategy. So if we think about like what can you diversify away, these systematic risks, these things you consume for being an investor in the market, the base effects you have to take in order to generate some returns are largely unpredictable, right? And fairly unknown. Like what happens on Liberation Day? which is what Trump sort of dubbed the 2nd of April. What do these tariffs look like? And therefore, do I sort of position for an outcome that is largely unknown? Is that the risk you want to diversify away? Probably not. Who would have guessed, right? If we sat in December and we had this conversation just before Christmas, and I sat here and I told you, I think Germany is going to be the best performing stock market of 2025, given its low growth rates and unstable government, aging demographics, and the US would underperform by a strong margin. Actually, the Mag 7 would go into bear territory, right? Yeah. You just sort of puts it a little bit into context. So then you say, okay, well, what can I diversify away? What do I want to diversify away? And that's the risk of the asset class itself, right? So the equity risk, the bond risk, the infrastructure risk, the property risk, because I can diversify away my US tech exposure with financials in the UK, right? But what I can't diversify away is having a portfolio that's completely reliant on central banks cutting rates, right? Because I don't know when that's going to happen. I don't know how that's going to happen. So make sure that, we're sort of reducing the forecasting risk element in the portfolio, these political dependencies and outcomes, and focusing on the risks we ultimately can diversify away. So to go back to your question, we say, well, what do we look at in a portfolio, right, given this context? And I think the answer is to make sure that, when we build a portfolio, we build one that can weather the storm. Right. So we know it can assume these risks, these geopolitical risks, these interest rate level risks, and so on, but it's not reliant on those macro factors to play out in order to generate your client's financial plan, ultimately, right? So to summarize, I think you probably want a portfolio of ideas rather than a single portfolio idea. You want to take deliberate positions and not inadvertent positions. And then you want to size that appropriately given that client's risk appetite. And if you follow that consistently, I think diversification is going to be your friend. But don't forget, we have to consume some risks in the market in order to generate returns.
I think it's so good. I love what you're saying there, because there's a lot of points that we could take away from that, and actually just dwell on them and understand them, and obviously help us to kind of feel at ease as investors, because myself and yourself, we're also investors. And the one thing that I really liked that you said that really jumped out to me was that risk is the price that we pay. And I think it comes back to, we have this conversation quite regularly with clients around being invested into the correct category of portfolio, matching or aligning with your objective. 100%. If you're going to go into an equity-based portfolio or a growth-oriented portfolio for a very predefined, very short-term time frame, that is taking on potentially unnecessary risk in that sense, because you don't have a lot of time to potentially recoup if there's a bit of volatility or a correction in the market. But if you're in the correct portfolio for the correct time frame, and you can kind of ride out that storm, pay that price and that short-term volatility, and you'll benefit in the long run. I don't know if you agree or disagree on that, but that's kind of what we try and encourage our clients to be, aligning their expectations with the objectives with the portfolio.
Spot on. And there's another level to that as well. So what you talk about is the sort of investors' attitude and willingness to take risk, right? But then as an investment manager, so as we work with your team and we're building these portfolios, right, we have the limit of risk that we can take within the portfolio, right? And yes, it's time horizon dependent and so on, but it's also the kinds of risks, right? So when we talk about active risk, right, the risk that you want to expose your clients to, that needs to be the risk of that asset class itself. Right, it needs to be the idiosyncraticness of the equity market or the bond market. The risk within credit spreads when I'm investing in investment grade and all of that. The risk I don't want to be taking is the macroeconomic, is the forecasting, is the outcome of a Russia-Ukraine war. So there's sort of 2 points. Is one, you can be quite deliberate in the risks you want to take, and 2, you could inadvertently get exposed to them as well. So diversification is not a one-off job, it's an ongoing job. And so assessing the portfolio the whole time to make sure that none of these things have crept into the portfolio is quite important. And then aligning that to the attitude to risk and the willingness to take risk. So there's sort of 2 components that come into a financial plan, portfolio management, and then clients ultimately meeting their goals, right? Which is what we're all after.
Yeah. And I think it's also what I love that you mentioned there in that second bit is around being able to take on different kind of outcomes from different market cycles or spots in the market cycle, as an example. You can't have that binary approach or be too reliant on a binary outcome Russia, Ukraine, and is there a peace deal, and when is it going to happen? I think if you have too much of a singular or too much of a focal perspective on that can have a concern, especially from what I understand from being in the industry for a bit. But obviously, if you as an asset manager have that binary call, it can literally go one of two ways. And then that's obviously not what you guys are trying to achieve in that. You're obviously trying to take a more diversified approach, exactly what you're saying, spread it across different assets, different sub-assets and so on. And then everyone is better off in that sense.
Absolutely. And I think just to hone in on the perceived diversification versus actual diversification, that is so important.
Yeah. And so maybe just to kind of use it as a segue is about, do we need to be reactive to market conditions? Okay, so we've diversified, we've constructed our clients' portfolios. Okay, so PMX, we've constructed those, and us with our clients, we've chosen or selected those particular portfolios. Do we need to be reacting to these market conditions? Tariffs, reciprocal tariffs, and obviously all the headlines that I mentioned at the top of the video. Do we need to be, as investors, reacting to those?
Yeah, I think that's what the market's conditioned you to think, right? So if you think about it, most people, they think in stories, right? It gives you comfort. You know what the storyline looks like. You sort of predict who's going to win. Is the euro going to get the girl? That sort of thing. And the market's very similar in the way that big asset managers and economists providing these forecasts gives you and your clients a sense of comfort that you know what the unknown is. The reality is you don't, and it's a security blanket which isn't that predictable and actually that comforting. So I think most asset managers we still see in the market and most of the market participants still talk about forecasting pretty binary or hard to predict outcomes. What will US tariffs look like? Therefore, should we be cutting all of our steel and aluminium producers within the portfolio? Will the war in Ukraine end? Should I be buying stocks like Rheinmetall, or will Siemens actually rebuild Ukraine? Right? These are all thematic questions, which in earnest no one really has the answer to. And those that have been invested heavily in defense today has not done so because of the policy shifts in Germany. They've been there before for a completely unrelated reason. It might be valuation driven, might be demographics driven, might be supply driven. So it's very possible to get these right sometimes, but it's very difficult to get them right consistently. And perversely, you might actually be exposing yourself to inadvertent risks that we spoke about earlier, right? This perception of diversification instead of actual diversification. So I think you want to always make sure that these things don't sort of sneak into the portfolio, which they can do, right? Market shifts, asset allocation changes, and so you could have these inadvertent risks in there. So when I'm sort of looking at the portfolio and when we're talking about it as an investment team, we look at the underlying funds we own, right? Because that's ultimately your levers that you're going to pull, right? To make these reactions that you just sort of discussed. You want to sort of relate it back a little bit to the SWOT analysis, right? So when you were from university, so is the fund and therefore the underlying securities, and let's use equity because it's easy to understand. Am I exposed to the strengths, the weakness, opportunities, and threats of that company? Or am I exposed to the level of the oil price? Am I exposed to the level of interest rates? Am I exposed to GDP growth? Because that's not what you want to be exposed to, because those things are going to sort of form a path of its own. It's going to be fairly unpredictable. But having true fundamental exposure to the asset class itself makes a lot of sense. I don't want my Chinese exposure in the portfolio to only make money if they issue large stimulus, right? I want the fundamental benefits of a BYD as an example, which apparently now can charge a car in 5 minutes. That's a true strength of that company. That's the risk I want exposure to, not EV subsidies, which would potentially come through the Chinese government. So hopefully that gives you a good contrast into kinds of risks that you want in your portfolio. And very often, the best thing to do is nothing really, right? And to stick to your investment strategy on the assumption that you have correctly diversified at outset, right? Once you have the comfort that you have true diversification and not perceived diversification, I think a lot of these decisions become a lot easier to make.
No, I agree fully. So essentially, in a nutshell, about not being reactive, but still being nimble. So having the right kind of process to put you in those right asset classes in the beginning and where you're exposing the client funds, but being nimble to opportunities, so being open to opportunities. So if things do change, you obviously can go in and take advantage of those opportunities. But from what I'm understanding, from what I'm hearing, not necessarily going to be reactive and obviously reacting to headlines and so on and so forth, or headwinds.
Yeah. It goes a bit to like thematic investing, right? So thematic investing has become extremely popular globally. And if you look at some of the analysis, right, a lot of the returns are actually made before the theme is launched.
Yep.
And thereafter, it happens to be, weapons of mass destruction, really, to some extent. And I think it's very similar like this. So understand the asset allocation, and your asset allocation can't be static, right? The only constant in life is change. But make sure that the changes you're making to your asset allocation is based on the fundamental things that you can rely on. So risk, right? The risk of the asset class is more consistent, and when that changes, that should be more predictable going forward. My return target on the S&P 500, your guess is as good as mine, right? And right now, such a good example where everyone's absolutely slashing their S&P 500 targets, where last year we were talking about 7,000 points, right? And just shows you how quickly that can change. And trying to chop your asset allocation to follow these very noisy market movements probably is going to result in unhappiness in the long term, right? But if you build the portfolio to weather the storm up front and make those incremental changes based on information that you can rely on, that's a far more consistent and successful investment strategy.
I fully agree. I think if you look at or if you listen to or read anything about Warren Buffett and his approach, and not necessarily having goes at thematic elements, but being aware of the opportunities, understanding the opportunities, and taking long-term views on those opportunities. That's where obviously wealth creation is kind of made. So maybe from there, if just in rounding up, so an encouragement to clients is obviously we can have complete kind of peace of mind that yourself and the PMX team, they're working really hard on, and I know they are, we have these discussions all the time, working really hard on ensuring there's not only perceived diversification, but there's actual diversification for clients. And with that, returns will come in time. So yes, there's periods where returns are maybe not where we would like them to be, but also to understand that that's part of the normal market environment. That is part of the cycle. We anticipate that. We do not anticipate prolonged, perpetual times of just continuously outrageously good returns. It's a normal thing to have a bit of volatility in your portfolio, in your return profile. And that doesn't necessarily mean that we need to be super concerned about it and be reacting to it if obviously the underlying metrics that we are monitoring are still aligned with the objective.
Yeah, I agree. And the one thing that's quite important, because you'll meet many fund managers as well, and everyone will tell you, focus on the long term, Travis. Markets is a marathon, and it's very important. And although they're right, performance is very important, right? Yep. Because if you think about what you guys are doing such a great job on is designing that financial plan, determining exactly how clients need to save, where they need to be tax efficient, which kind of wrappers they need to use. Hey, the portfolios need to perform that sort of return function based on your analysis, right? And so shortfall risk is real, right? So performance matters, but the way you get there is quite important as well. So risk matters. So performance within a risk framework is very important, because why? The journey is important, right? No one walks into your office in the beginning of the year and says, "Hey, Travis, I really look forward to the roller coaster of returns we're going to have this year with a hope of making some money." No, they want to consistently achieve their investment outcomes, and so the journey is super, super important as well.
Honestly, I agree so much. There's more and more data that's coming out relating to that specific point, especially on the financial planning side, and how a more of a consistent, and I know this is one of your guys' key kind of metrics and structure points, is the consistent return, the consistent outcome that leads to the investor behaving in a more appropriate way, or can I say a more aligned way with the objective is maybe a better phrase to put it. And with that, whether you get the numbers hypothetical, but whether we get 12% or 13% every single year after costs and all those wonderful things, yes, we're always going to try, like you said, achieve a level of performance. We want to get those returns for clients. There's no doubt about it. Okay, but it's obviously, if you are going to be sitting through a profile that's extremely volatile, the likelihood of that investor, and this is what the data is showing, the likelihood of that investor remaining committed over a longitudinal time frame to that objective, it diminishes rapidly. So if we can have a smoother, not smooth, we're not saying completely smooth, there are bumps, But if we can have a smoother, slightly more predictable return profile for clients, that increases dramatically the likelihood of the clients achieving the end goal, which is, in my mind, the most important outcome in this whole situation.
Yeah, I mean, to sort of summarize that, I'll bring a little bit of UK terminology to the sunny beaches of Ballito. Mind the gap, right? So volatility has a nasty way of exposing our behavioral biases, right? The absolute dying urge to do something in order to protect our wealth from losses can often be so detrimental to long-term wealth creation. And it's really reflected between the difference, what I call investor returns, i.e. the statements your clients get on the actual rands and cents or pounds and pence return that they get, versus investment returns, which is the number we put on fact sheets. I mean, the difference between that is, more often than not, behavioral biases, short-term, irrational decisions during periods of heightened volatility. So as you continue to read these media highlights, as you continue to see Trump tariffs, as you continue to see geopolitical risk, just remember that it's all about time in the markets rather than timing the markets. And volatility creates opportunity, but you can only benefit from that opportunity if you are invested.
Alex, succinct, perfect. Great kind of ending to the video. I don't think I could add much more value to that, but I mean, it's exactly that. So guys, anyone who's watching, it's exactly what Alex has just referenced at the end there. I think if we can control to some degree our behavioral bias, if we can try not to influence the investments as much, it's a very difficult thing that I'm saying, and that is what obviously we are here to help clients with and manage that and have those tough conversations with clients and make sure we kind of stay the course. But yeah, Alex, thank you so much for your time. I really appreciate it. I hope there's some sun on the way across to your side on the UK.
We're getting there.
It's supposed to be cooler now. We're approaching, we're in autumn, but let me tell you something, the air cons are pumping here today. It's really hot. So
you're making me jealous. Sounds great.
Yeah.
It's been a real pleasure to be on, and I look to a future episode again.
Yeah, Alex, thank you so much. Have a wonderful day. Okay.